everybody likes a weak dollar. Practically everybody. I mean, investors, entrepreneurs, people who own stock. And the strange thing is when people hear the word weak dollar, they think negative. It's often misassociated with not being negative. What is the weak dollar? A weak dollar? Well, it's when the currency, when there's a lot of the currency being printed and a lot of the currency in the environment causes inflation, mainly. But what people look for in a currency to see whether it's weak or strong is they want to know if the currency you can trust. They want to know if the dollar itself is not going to be manipulated for the benefit of the United States. Weak dollars sometimes indicate that a government may be at risk. And as we said, the government may be printing more than what it has in reserves. Well, like we said, who benefits from a weak dollar? New home buyers, exporters, banks benefit. Visitors from foreign countries to the United States because the cost of the dollar is so cheap. If you're an entrepreneur, you want to start up a business, there's more money available. The key losers from a weak dollar are people who are bondholders. It also has an effect on the housing market, which could be positive. There's something called purchasing power parity, and that's how the world judges how much your money is worth in the world. And purchasing power parity drops when the dollar is weak. But the best way to judge a dollar strength or weakness is over a long period of time. You can't measure it in a matter of weeks. It should be measured in a matter of years. And the way the dollar is measured is through something called the USDX, the United States Dollar Exchange. It's the dollar index. And it's made up of a basket of foreign currencies, which are the euro, the pound, the krona, and the French franc. The Federal Reserve System of the United States is America's central bank. It started in 1913, and the Federal Reserve Bank right now is under the control of Chairman Jerome Powell, and he's talking about next year maybe 2 rate cuts in the rate of the dollar. One of the key things America gains with the strong dollar is something called hegemony. By being the world's reserve currency, you can export inflation. And most of the trading in the world is settled in US dollars. So a weak dollar affects the volume or the amount of money in which the US is going to get for its goods. Most of the history of the United States has been a history of the strong dollar. A couple of important events that occurred in reflecting to the dollar is in 1944, the Bretton Woods Agreement, where the dollar was tied to the gold standard, which meant the dollars had an equal price in gold. So you can use a dollar as a receipt for gold, pretty much said. But that all changed in 1971 when Richard Nixon announced that he was detaching the dollar from gold. He said it was temporary, but the dollar floated from that point on. If you enjoyed the video, please give me a thumbs up and please subscribe and have a great day. Bye.